You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music can mean but one thing. It is time, once again, listeners, for Education Wednesday. That means your double dose of education. It always kicks off with the premier source for options education out there. Yes, we're talking about Options Bootcamp. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. Reminding you, we have a lot of people come in. They love to mainline bootcamp. And hey, we love you all, but you're missing out on a whole bunch of other stuff. We gave you, accidentally, as it turned out, gave you a little sneak peek of OPR in this feed last week. So hopefully you folks all like that. If you're listening to Options Bootcamp, you at the very least should go out and also subscribe to Options Playbook Radio. All of you out there who want options from the beginning, soup to nuts, along with some written material that goes along with it and a website that goes all along with it, you can have that there as well. So between this show and that show, you will really be well armed for whatever the options markets throw at you. And of course, you get to throw your stuff back at us as well. Your questions, your comments, your insights, your pearls of wisdom. You have a question, you have a topic you want us to discuss here on Options Bootcamp, hit us up. You know where to find us at Options, most of the major social media platforms, or via our website, questions at theoptionsinsider.com. Also works if you're in downtown Chicago. Smoke signals. They'll get to our studio here as well. Keep those questions and comments coming. We do love to hear from all of you folks out there. Let's see who we're hearing from on the program today. He is the founder of Market Taker Mentoring, the author of one or two or half a dozen options-oriented tomes, and also quite the musician, if I do say so myself. Mr. P, welcome back to the show, sir.
Hey, Mark. Thanks for all the kind words.
That's it. That's all the kind words you get for the rest of the show. I'm slamming you for the rest of the show as we dive right on into a little bit of the old basic training.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out. Do you hear me? Yes, sir. Basic to complex. Yes, sir. There will be no failures. Do you hear me? Yes, sir. Pull in. Yes, sir. Print bear to learn. Yes, sir.
Oh, everybody, welcome to the basic training, the portion of the show we break down some basic options concept or strategy or technique and explain how you can utilize that in your own portfolio. Before we get to that, Mr. P, lots going on in the world of options, lots going on in the markets. We're seeing seemingly endless rallies punctuated by aggressive, maybe somewhat spooky sell-offs, then rallies again. Vol is coming in, vol is coming in. Oh, there it goes back up again, then it's coming back in again. So a lot of topsy-turviness, to coin a phrase here, has been going on in the markets since our last episode. Sir, what has been catching your eye out there in the overall markets and the options landscape and the volatility landscape since the last time we chatted, sir?
Oh, I've just been encouraging our students to beware of the conflicting narratives, kind of think for yourself a little bit long term, but not be afraid for on short term trades to react to some of these overreactions to pretty dynamic narratives. The one thing we were afraid a while back about inflation, God forbid, it was going to raise interest rates, and the interest rates on bonds and notes were ticking up a little bit, and that was causing a market sell-off. And then, that stopped. And I think that people, or at least people in my camp, are digesting this inflation news and inflation narrative a little bit differently now. If you think about it, what is inflation? Inflation is a rise in the price of goods and services, right? Well, guess what? All these listed companies in the stock market sell goods and services. They're going to be selling them at higher prices, and that's going to make the earnings figures higher. And stocks are priced off earnings figures. And so inflation becomes a justification for higher stock prices, for the market to be higher. And then Janet Yellen said that there was a chance that, I'm kind of paraphrasing, that interest rates could go up at some point. And she backpedaled a little bit from that. But that's part of the attraction, I believe, for why the Fed wants a little bit inflation, so that they have room to raise interest rates, which they wouldn't have otherwise, without it doing any problems to the economy, and in fact, maybe being beneficial. All that being said, tops take longer to form than bottoms, and we've got this sort of rounded top forming a little bit here. I guess for me, I see the possibility of stocks moving higher. But if there was a little bit of a pullback, I wouldn't be dreadfully surprised. The VIX is still under 20, which indicates that investors aren't that scared. I don't know. I think if I see dips, it looks like a buying opportunity to me.
And you're putting all that money, just to clarify, into a pearl of wisdom, sir. So you're putting all that money into Dogecoin, correct?
That's right. Every single penny that you pay me for doing this show, Mark, I'm putting into Dogecoin.
There you go. So you're changing the name. It's no longer MTM, right? It's going to be Dogecoin Mentoring going forward. And your advice is just buy Dogecoin. When in doubt, buy more, right?
Yes, that's a subsidiary of MTM, to be sure.
DM, Dogecoin Marketing, coming soon from the team at MTM. Well, let's get into some of the fun stuff we have going on today. Like you mentioned, Dan, we're kind of in this weird topsy-turvy area. Some folks think we're poised for a pullback. Other folks think we may have some rally ahead, which, of course, is what makes a market out there. These are times where you may be looking at some of your equity portfolio and saying, what can I do with this? What more can I do with this to eke a little bit of returns? Let's say we are in a bit of a kind of sideways market for a little bit. You want to just sit on that equity? You want to do something else with it? So this is a topic that has come up quite a bit on the network of late. I thought it'd be a good time to revisit it here on the show. We haven't really sunk our teeth into it in a while here on the show. It's my personal favorite go-to starter option strategy for a new options trader. I'm talking, of course, about ye old covered call. Dan, I know you and I have kind of discussed / debated this in the past, but I'm curious. That's my go-to for a recommendation when someone comes to me and says, hey, I'm a new kind of options trader. I've been trading stocks for a while. What should my first trade be? Usually 9 times out of 10, I'm going to tell them the covered call. Is that your go-to as well, or do you have some other first trade that you usually recommend?
Yeah, that one is a good sort of halfway house trade from investor to options user. So anybody who has a background in investing and wants to be better with their investing, oh yeah, man, I am always ready and willing to recommend that they explore learning how to do that. And sometimes, my second most recommended one is, buying long calls for traders. But I think that the utility of covered calls is probably much greater because, look, most people are investors of some sort. You sock a little bit of money away for retirement, but not everybody moves on to the more active trading. So covered calls are just super, super versatile.
The halfway house for stock traders. I don't think I've ever heard it described that way before. Talk about damning with faint praise, but yet also not entirely inaccurate as well. So I can get down with that, even though it is an interesting description at the very least. Come join the halfway house for you stock traders who want to just get your first taste of maybe kind of be the opposite. A halfway house is supposed to kind of like cure you, right? Get you back into society. What's the thing that's going to get you down the rabbit hole more? Something, your first taste house, I guess, would maybe be the way to go. So what the heck are we talking about, listeners? A lot of you come into this show. You're new to options. You're new to all this stuff. So again, you can do a deep dive into our archives as well. If you want more on the covered call, you can also go check out Options Playbook Radio. Brian's done multiple episodes about the nuances of the covered call. We can talk covered calls for days. In fact, we just did it on our Advisors Options show. A little bit different audience for that show, but it seemed like a good time to revisit it here. What are we talking about, Dan? What are we talking about with covered calls? Let's give you an example here. All right, so everyone's favorite name, XYZ. We've all made and lost fortunes. And XYZ, it's a fickle mistress to wrap your hands around sometimes. What is XYZ up to? In our example here today, XYZ is trading right at exactly $100. You actually are in a good position. You're long 1,000 shares of XYZ from back at 70. You bought it back at 70. So you're sitting on $30 1,000 times, aka $30,000. You're looking pretty good. You're pretty happy probably in this scenario. So this is kind of analogous to what we're looking at right now. People are sitting on some gains in their stocks, but you also, and maybe in our scenario, and maybe probably in the market right now as well, maybe you're not that sure about what the future holds. You might think XYZ is going to languish around 100 for a while, maybe not move that much in either direction. You might think the broad markets are going to do that as well. So what can you do? Well, a couple of things. You can obviously take your money and run, close your XYZ. You're sitting on a $30 profit. Maybe if you bought some stocks down in the nadir last year, you're sitting on some good profits there as well. You can always close those out. That's, of course, has some hits with it. It has a tax hit. It also takes away any potential upside you may have in this name as well. You could kind of do the old hodler crypto route, just kind of sit there and hold on for dear life and hope the rally continues and probably wait a little while for something to really develop in one direction or the other. Or our third option, the one we like here on the show, is to sell what we call a covered call against that position. So a couple of things have to be done to really effectively sell a covered call. First, you have to sit down with yourself in your heart of hearts and say, okay, be honest with yourself. Don't lie to yourself. Be honest with yourself. Say, what do I realistically expect from this stock over the course of whatever time frame you're looking, the next month, the next few months, whatever the case may be, and say, okay, you know what? In this case, I'm sitting on XYZ from 70. If it rallies up to 110, I'm getting the heck out of Dodge. I think that's a good run. So in this case, you might be inclined to sell the 110 covered call against your position. So what are you going to go out? You're going to sell the calls on the $110 strike. And remember, the multiplier on equity options is 100. So you have 1,000 shares. So you need to sell 10 contracts to cover your entire position. Now, in our example, we'll make the math nice and easy. You get a nice $1 for each of those contracts. Remember, $1 times 100, that's the multiplier. So that's $100 in premium for each one. You have to sell 10. You just collected $1,000 or 1% of the value of your portfolio for just agreeing to say, I will sell my stock if it gets to that point. Now, you might be doing that already in your stock portfolio. You're probably familiar with working limit orders to buy and limit orders to sell all the time. If you just worked a limit sell order in XYZ for 110, guess what you get for that? Nothing. And we have all learned over the course of the past year, you've learned many things. One of the things we've learned is that working resting orders in the stock market entails some risk, and it also limits your opportunity. In this case, you're limiting any upside beyond 110. You should be compensated for that. What if you have a GameStop on your hands and it goes to 1,000? You're missing out on that. So you should be compensated for that. In our scenario, you're getting compensated 1%, which is a heck of a lot better than just working an equity order. So I'll break down some outcomes in a second. But first, Dan, what are your thoughts here on this strategy in general, the covered call in general, and some of your use cases? When do you like to use a covered call? When don't you? And in general, your overall thoughts on this fantastic, as you termed it, halfway house position for options traders.
Mark, I like to use the covered call most of the time. I was going to say every day, but there are a couple of times that I pull back. My main use for it is not my only use, but my main use is on on stocks that are already existing in my current portfolio. Long-term investment holdings. And when I say stocks, that's inclusive of ETFs. If I own a stock or an ETF that's in my existing portfolio, and a couple of criteria, implied volatility is a little elevated, which is ideal, because then I can sell some juicy premium. Most of the time, I'm doing a covered call. The only time that I really pull back is if I have some reason to believe that the stock is very likely to grind higher and implied volatility is low. And when I say grind higher, in this context, I mean, has some momentum to it, has some force behind it. If it's just going to grind higher, if I believe that the stock's just going to grind higher slowly, I'm totally okay with that. But if, like for example, when the market crashed during COVID, I ended up, scooping up some shares of Spiders at lower prices, and there was no way that I was going to sell calls against it. I just pulled out all my calls and let the stock rally until it got to a point where I was a little bit more comfortable selling calls.
Now let's break down some scenarios here. So an example, listeners, XYZ trading at 100. You're long 1,000 shares from 70. You decide in your heart of hearts, you don't mind selling it if it rallies another $10. So in our example, you're going to go out and sell a 1-month call on the 110 strike. That means you agree to sell your stock anytime between now and that 1 month of expiration for 110. So obviously that's $10 above where it's trading right now. So you'd love to sell it there now. No one's going to exercise these calls on you right now. That'd be nice if they did. You'd say, thank you. That's a great gift. But if XYZ closes above 110 at expiration, now, of course, you have agreed to sell your stock at 110. So you are clipping your upside a little bit. So in that scenario, getting that $1 or $1,000 total when you factor in the multipliers, aka 1%. To do that, now you can see how that could be useful over time. Let's say in this example, by the end of that month, by expiration, XYZ is still below 110. Well, what happens? Well, you keep that $1, aka $1,000 worth of premium that you sold. That's yours. That's yours to keep. And now you can decide, depending, let's say XYZ kind of stayed where it is, right around 100, like you feared. You could turn around and probably sell that call for a similar level again and rinse and repeat month after month, which is why this trade is so attractive for a lot of people. It effectively allows you to create your own alternative dividend income stream on a particular underlying. Now, it's not the same thing as having a dividend stream, obviously, because there's other things that go along with that, but you're creating an income stream on your own, on an underlying you already own, which is very attractive. You can keep doing this month after month. Some people like to do it in the weeklies, whatever your flavor is. It's a great way to do it. And also for people who are newer to the options market and they want to be a little bit more hands-off, they're a little bit scared, or maybe they just want to dip their toes in a little bit at a time. I don't usually like to recommend the set it and forget it approach, but if there is a strategy that plays well with that set it and forget it approach, it is the covered call. In our example, you could come in, you own this stock at 100, you sell that 110 call, you collect $1,000 or 1% for it. You wait a month. If nothing happens, you can do it again. It's very much a set it and forget it approach if you want to go that way. Now, of course, you can do better if you're more active. But for a lot of people who are busy, financial advisors and asset managers, they use a lot of covered calls. And they pretty much do it in that set it and forget it. Usually they'll go a little bit farther out, maybe sell the quarterlies instead. But they will write covered calls and kind of set it and forget it and move on to the next trade. So if you're new, you kind of want a little bit more of a hands-off strategy. This could be one that is attractive to you. Now, the other flip side of this, let's say XYZ closes above 110 at expiration. What happens? Well, you're going to sell your stock at 110, no matter where the stock is. So if you have a GameStop on your hands, you're up at 1,000, you're still selling it at 110. Plus, remember, you collected an extra $1 to sell that option. So your effective price to sell it at is actually 111. It's 110 plus the $1 you collected for selling that call, which again, $11 above where the stock is trading right now. That's a nice little extra. So you can't really look askance at that. So a lot of different ways you could structure your covered call, the time horizon, all that kind of fun stuff. Dan, when you're setting up your covered call, like you said, you like to use it on longer term holdings in your portfolio that have had a little bit of elevated implied volatility. When you're doing a covered call, what's your optimal structure? Are you like a 1 month kind of guy? Are you out in the weeklies? You going quarterly? How are you typically setting them up?
I'm typically in the shorter term horizons. Like, for example, in the spiders, where I'm very active in covered calls almost constantly. I keep that anywhere from 2 days to, if I'm beyond 7 days, I'm like, oh my God, this forever. That said, every once in a while, I will look to go out a little bit further. For example, I've been watching closely AT&T, and I've owned that for a while, and it's been paying a really good dividend relative to the stock price. But now the stock price is higher, so percentage-wise, the dividend's not as good. And I'm like, well, how do I get, quote, a bigger dividend, like you referenced earlier, Mark? And I've been looking at the covered calls, but that's a situation where the stock has been a little bit hot. So I'm watching it. I'm waiting for it to break out a little bit higher, because if it does break out a little bit higher, then the percentage I'm collecting for the dividend becomes not as worth it. I could probably employ that capital better somewhere else. And so, like you mentioned, set it and forget it. Then if I get filled on the call and I sell the stock, great. Now I freed up that capital to be able to put it to better use. And if I don't, then I just collected basically a double dividend payment.
There you go. Something else to keep in mind, synthetically from a risk perspective, selling a covered call, the same thing as selling a short put. So if you're not comfortable selling puts out there, then you should also be a little leery selling covered calls as well. Obviously, people think of a covered call as a protective strategy. Obviously, for the reasons I just outlined, it really isn't. It can give you a little bit of an extra buffer to the downside. In our case, you get an extra $1 worth of juice. So if the stock drops $1, you're still breaking even because you collected $1 to write that covered call, but it's not exactly a protective strategy. Now, there are ways you can play with the covered call a bit, and there are a lot of different ways you can do. We'll hit on a couple very popular ones right now. First off, let's say you're selling a covered call in a name, but maybe you're not that sure that maybe you're not sitting on the next GameStop. So maybe I could argue in that case, maybe you shouldn't be selling the covered call at all. But if you want to get a little bit of income, but you're still not a little bit sure, maybe you want to sell a call vertical instead. So going back to our example, you sell the 110 call again for $1, but then you're a little worried. What if this thing starts trending north? You think if it gets well beyond 110, it might start trending north again, and you want to participate there again. So you turn around and you buy the 115 call, in our example, for 25 cents. So what have you done now? You've collected, first off, a net credit of 75 cents as opposed to $1. So your income dropping a little bit there. But on the plus side, if this stock rallies through 110, gets all the way to 115, and then keeps rallying, guess what? You're playing again beyond the 115 strike. So you're going to miss out between 110 and 115. You sold that spread for effectively 75 cents. So you could see that thing come back to bite you to the tune of $4.25. But outside of that, you can participate. So if it goes off to 130 or something and beyond, if you are horribly wrong in your estimate on the stock, that could be one way you may want to go, right? The vertical instead, getting a little bit less premium for it, but in case you have some explosive upside, that's one way you could adjust and upgrade your covered call. Another way that's very popular, particularly with a lot of asset managers and advisors out there who want to protect their clients' portfolios, but also generate income, position called the collar. I've often referred to it as the holy grail for asset managers and advisors out there, but it's also a useful position for retail traders out there as well. You want to collar your stock position. So same exact scenario. You have the stock, you bought at 70, you're at 100. You turn around, sell the 110 call yet again for $1. Now you have $1 worth of premium, $1,000 you can maybe play with a little bit. Rather than just keeping that premium and collecting a dividend, you can also put it to work for you. In our scenario, you could also buy some downside protection because you're a little bit concerned. What if this XYZ is a little bit frothy? The markets right now are a little bit frothy. Maybe you can argue a little bit top heavy. So if you're concerned about that, maybe a little bit of downside protection wouldn't be the worst thing. So in our example, you go out and find a put that also is trading for about $1. So that would be effectively, in our example, the 85 put. Because remember, you're not going to get the same level of protection. Puts are typically going to cost more than calls from an implied vol perspective in an equity like this. So you have to go a little bit farther out. So in our example, we've created what's called a zero cost collar. you have now sold a 110 call. So your upside is collared because you're not going to participate beyond the 110 strike. And to the downside, you've also limited your downside risk to the 85 strike. And the cost for that is nothing because you sold an option for $1. You bought an option for $1. So your net payments are zero. You're even on the trade and you've collared your position. So if it goes above 110, you're out. If it goes below 85, you're protected there as well. So that's the way people like to use collars. There's a lot of different ways you can do collars. We gave you the zero cost example here because it's easy, but you could play with that. You can push the put out a bit, push the call forward a little bit, keep rolling the calls. And there's a lot of different ways you can play with the theta on the collar. Go back and check out some of our archives if you want to know more. In general, the collar is a great way to get some protection without having all of the outlay that you would if you're just out there buying these puts all the time. Another way to do it, take the collar, upgrade it yet again. So we call it the collar with a bit of a put kicker. So same exact example before, you sold the 110 call for $1. You're buying the 85 put also for $1. So you're kind of even there. Then you decide, you're not really that worried about a huge sell-off down to like 30 in XYZ, right? So you want to protect against a more near-term sell-off. So instead of just buying the 85 put, you buy the 85 put spread. You buy the 85 and you sell the 75 put, in our example, for $0.25. What does that do? First off, gets you a credit again. You're collecting 25 cents as opposed to nothing on this trade. So you get a little bit of income stream, not a ton, but a little bit. And then B, now in return for that credit, you've limited your downside protection to that 75 strike. So effectively, you bought a put spread. And so now you will participate. You'll be protected all the way down to the 75 strike. But then bets are off. You're participating again to the downside. So if XYZ is annihilated, then you will be feeling that below the 75 strike. So again, you only do this type of trade if you're concerned about very limited near-term downside and not a big sell-off. You can get even wilder and crazier with a strategy that my buddy Brian over there on OPR likes to call the fig leaf, talks about it all the time. It's effectively using stock substitution to swap that out for the underlying, take the underlying, sell it, swap it out for a long-term in-the-money covered call, at least 6 months, maybe a year or longer, and then turn around and write covered calls, really quasi-covered calls, AKA, that's why it's called the fig leaf. You're partially covered against that. It's a much more complicated strategy. We don't have time to get to it here. I encourage you to check out OPR if you want to learn more about that. That might be an interesting topic for an episode here again as well, Dan, the nuances of stock substitution. But I laid out a bunch of different ways you could play with the covered call. What are your thoughts on those, Dan? Any that you like, any that you don't like? And also, what are your thoughts on maybe a future episode on the whole fig leaf, the stock substitution with a quasi-covered call, sir?
As far as the stock substitution, I do like those as well. And I've been trading one of those diagonal on QS because that is a stock that is on my short squeeze list. And just looking at it, I was thinking that there's a reasonable chance that it wasn't going to short squeeze in the immediate future. It seems like those things kind of get a little bit hot and cold. And so I bought a long-term call, but then I sold some shorter-term, higher volatility calls against it. And what that did is it just took in premium against that call that I own so that, after a few rounds of rolling and collecting these premiums, I own the call at an extremely low cost basis. And I bought, what was it? I mean, a few months out on that call. What do I got here? Yeah, it's the January. It's the Leaps calls, and I just been chipping away at the premium that I paid for it, and so it's been working out pretty darn nicely. It's down a little bit today, but that's okay. Anything I lost on delta and theta on it, I made more than that on selling option premium. So yeah, I love it in the right situation.
Indeed. So let's do a quick recap here. Then our music means we're coming up against it for this episode. But stay tuned, listeners. One of the benefits of listening live, you don't have to wait another week. Episode 2 is coming hot on the heels of this one. But let's wrap up the covered call here. Again, you go back into our archives of Options Bootcamp, also Options Playbook Radio, for many great discussions about covered calls. Also, check out the most recent episode of the Advisor's Option, a deep dive into a firm that does nothing but covered calls and all the nuances therein. But a great way, if you have an underlying you're sitting on right now, maybe you got some gains and you think it might be a little bit sideways for a little while, a great way to jazz up and drive some income from that. You can also upgrade it with covered call verticals. You can go the collar route or even the stock substitution / fig leaf with a quasi covered call route. A lot of different ways you can go with the covered call, but it's my preferred starter option strategy. I know it sounds for Dan. He's like a big fan of it as well. So if you're wondering how you should get your feet wet in these options things, you've been trading stock for a little bit, covered call could be a great way to go. Speaking of going, Dan, we got to get going. But before we go, if folks are intrigued by anything you're talking about, want to go check it out for themselves, where should they go? What should they do?
Yeah, I have a kind of constantly running webinar on covered calls, and I actually break it down and make it extremely simple. I mean, for somebody who's never traded options before, you're instantly going to get what I'm talking about and be able, by the end of it, be able to take the next step and get started right away. And you can register for it at danpassarelli.com/webinar-reg-1. So Dan Passarelli, that's DANPassarelli.com/webinar-reg-1, and register for that. It's constantly running, and I think you'll really enjoy it.
There you go. Check it out, and check us out next week on our next episode of Options Bootcamp.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.